Hey guys, what's going on? Welcome back to the channel. So, let's be honest, investing can feel quite overwhelming. You hear about stock picking, market timing, technical analysis, and 1,000 different strategies that promise to make you incredibly rich. It's a world filled with so much noise and complexity. And for many people, especially here in Canada, it leads to a state of analysis paralysis, where people end up doing nothing at all. For years, I've personally looked for a solution. I just wanted a strategy that was very simple, effective, and backed by some sort of evidence, as well as the one that would let me build wealth without having to be checking my tickers all day and glued to a screen. And that search led me to one single investment that now makes up my entire portfolio, pretty much. That investment is XEQT, the iShares Core Equity ETF Portfolio. And in this video, I'm going to do a deep dive and give you my personal top 5 reasons why I, as a Canadian investor, have chosen to go all in on XEQT. We will break down exactly what you're buying, look at the companies and countries inside the ETF, dissect the fees, and figure out why its structures is, in my opinion, one of the most brilliant solutions of everyday long-term investor. So let's get into it. Reason number 1. The power of ultimate simplicity. So my first reason, and perhaps the most important for my sanity, is its ultimate simplicity. XEQT is what's known as an all-in-one or asset allocation ETF. Think about it this way. Building a traditional diversified portfolio, as recommended by professionals, is like building a computer from scratch. You have to do a lot of research and buy the processor, the motherboard, the graphics card, the RAM, the power supply, and everything. And on top of that, you need to figure out how it all works with each other by having to put them together in the right proportions to make sure everything is as expected. You also have to maintain it, updating drivers, swapping parts over time. And this is exactly what you do when you buy individual ETFs like VCN, XAW, or VTI and VXUS. It really works, but it requires a lot of knowledge, discipline, time, and ongoing effort. XEQT is like buying a high-end pre-built computer from a trusted brand. So you don't quite get to pick your own processor, your own motherboard, but everything works out of the box and you get all the best fitted components, professionally assembled and optimized to work together perfectly. All you do is just plug it in and it works. With one click on one platform, I can buy one ticker symbol, XEQT, and all of a sudden I'm diversified across thousands of stocks from every corner of the world. You don't need to worry about which percentage to allocate to which country. It's all done for me. And this simplicity is not about being lazy. It's really about being efficient. It removes the single biggest point of failure for most investors, which is ourselves. It prevents us from tinkering, second-guessing our allocations, and from making emotional decisions. Trust me, I've made plenty. One fund, one decision. It's that simple. No need to refresh your phone checking if the price went up and down every day. My second reason is the incredible and truly global diversification that XEQT provides. As Canadians, we often suffer from something called home country bias. We tend to outweigh our portfolios with Canadian stocks because they're very familiar and we know them, we see them every day. But the Canadian stock market, the TSX, currently makes up less than 3% of the entire global stock market. Overinvesting in Canadian market means you're missing out on the 97% of the world's opportunities. XEQT solves this problem beautifully. It's designed to give you a slice of the entire global economic pie. Let's look at the target weights. So the current United States allocations are approximately 45%. That gives you a huge stake in the world's largest and most dynamic economy, with exposure to giants like Apple, Microsoft, Amazon, and Google. Of course, there's also Canada, which is actually approximately 25% of the entire ETF, which is deliberately outweighing for Canadians. It helps reduce currency risks and aligns with our domestic economy. But it's not so large that it limits global growth potential of our ETF. Of course, you get the big banks like RBC and TD, as well as Shopify and our major resource companies. There is also a list of international developed markets, is approximately 25%. And this is your exposure to other major economies outside of North America. So think of companies like Nestle, in Switzerland, Toyota in Japan, and ASML in the Netherlands. And lastly, there's approximately 5% allocated to the emerging markets, which gives you a foothold in the fastest growing economies in the world. I mean, here we're talking about companies like Taiwan Semiconductor, Tencent in China, and Samsung in South Korea. This level of diversification is your primary defense against risk. Think back to the lost decade from the year 2000 to 2009. The US S&P 500 actually had a negative total return over that entire 10-year period. If you were only invested in US stocks at the time, you made no money for a decade, which is ridiculous. However, funnily enough, during the same period, Canadian and emerging market stocks performed exceptionally well. Because XEQT holds everything, it can weather these regional storms and capture growth wherever it happens. So we don't have to rely on only one country like Canada or the US. Reason number 3 is what's actually inside XEQT. As I mentioned, it's a fund of funds. It achieves its diversification by holding 4 other massive low-cost iShares ETFs. So, quite simply, by buying XEQT, you're essentially buying these 4 funds in one tidy package. Number 1 is ITOT or ITOT, which is your US engine that holds over 3,500 US stocks, covering the entire market from mega caps to small caps. Number 2 is XIC, which is the S&P and TSX capped composite index, which is our Canadian content. It tracks the broad Canadian market, holding over 200 of our largest companies. Number 3 is XEF, which is a core index ETF that covers your developed international markets. EAFE stands for Europe, Australasia, and the Far East. This fund holds over 2,500 stocks from countries like Japan, the UK, France, Switzerland, and Australia. Number 4 is XEC, which is the Emerging Markets IMI Index ETF. I would call it the growth focus component, which this fund holds over 3,000 stocks from more than 20 emerging market countries. So when you add it all up, a single share of XEQT gives you ownership in over 9,000 companies worldwide. You become a part owner of nearly every major publicly traded company on the planet. This isn't just diversification, it's total market ownership. My 4th reason is one of the most critical factors for long-term investing success, which are low fees. Because fees are simply a silent killer of returns. They're a guaranteed loss that you experience every single year, whether the market is up or down. The average actively managed mutual fund in Canada has a management expense ratio of around 2%. That might not sound like a lot. I mean, what's 2%? But it's devastating over time and a big chunk of money. On a $100,000 portfolio, a 2% MER costs you $2,000 every single year, just like that. Now, let's look at XEQT. The current MER is around about 0.2%. So if we do the math here, it's actually a very simple math. On 100,000, 0.2% MER is going to cost you $200 per year. So you're saving $1,800 every year compared to the average mutual fund, which I would say is not bad. Over an investing lifetime of 30 or 40 years, the difference in fees can compound into hundreds of thousands of dollars. That's money that stays in your pocket or in your portfolio working for you instead of staying in the pocket of a fund manager. So this ultra low cost is a massive and undeniable advantage, in my opinion. And I know you must be tired by now, so let's get to the final reason. My final reason is a feature that works silently in the background to enforce investing best practices, which is automatic rebalancing. The target allocations I mentioned earlier, 45% for the US, 25% for Canada, etc., are not static. Over the course of a year, if the US market has an absolutely fantastic run, its swinging your portfolio might drift up to 50%. At the same time, if international markets have a bad year, their weighting might fall to, let's say, 20%. To maintain your strategy, you need to rebalance. Sell some of the winner, which are the US stocks, and use the money to buy more of the loser, which is, in this case, the international stock, which enforces the golden rule of investing, to buy low and sell high. But doing this manually is incredibly difficult. Trust me, I've tried. It's psychologically tough to sell your winners and buy assets that are clearly currently performing very poorly. Many investors fail to do it, letting their portfolios become dangerously concentrated. But with XEQT, BlackRock, the fund manager, does all of this for you. They handle the rebalancing within the fund, which means your investment is always on target, always disciplined, and it happens without you lifting a finger or incurring any trading commissions or charges. It takes emotions completely out of the equation, which is arguably a single most valuable feature an investment product can offer, at least to me. So anyways, there you have it. My top 5 reasons for investing exclusively in XEQT: the ultimate simplicity, true global diversification, a robust structure of underlying funds, rock bottom fees, and disciplined automatic rebalancing. For me, XEQT isn't just an ETF. It's a very comprehensive investment philosophy packaged into a single ticker. It allows me to participate in the growth of the entire global economy in the most efficient and low-cost way. It's also incredibly hands-off. It's a strategy that helps me sleep at night, confident that I have a sensible, diversified plan in place for the long term. Now, this is my personal strategy and not financial advice. As I mentioned earlier in the video, I think you have to assess your own risk tolerance and financial goals. But if you're a Canadian investor looking for a powerful and yet simple solution for long-term growth, I genuinely believe that XEQT deserves a very serious look from you. So anyways, what are your thoughts? Do you use all-in-one ETF? Have you ever heard of them, or do you prefer a different approach? Let me know in the comments down below. Anyways, thank you for watching. Don't forget to hit that like button and subscribe if you get any value from this video. And I'll see you in the next one. Take care.